now the price of gold is in the high 1900s, and it's really just a spitting distance, maybe 5% away from an all-time high, which I think a closing breakout over 2070 would represent an all-time high. And so that should not be happening, all other things being equal. I mean, real interest rates have gone up a lot, yet the price of gold has gone up. And what I think is going on is gold smells what's coming next, which is also outlined in my quarterly letter, which is that the Fed will have to, at some point, change their policy. I expect, and even if we don't go with that reset, I think just on we continue along, they somehow manage to keep this system together and keep kicking the can. I think we're going to end up with a, $3,000, $4,000, $5,000 gold price easily.
The Fed is expected to keep interest rates unchanged in the range of 5.25% to 5.50%. Investors hope that higher U.S. long-term bond yields and declining price pressures will back the Fed to keep interest rates steady. The market trader Lawrence Lepard sees the price of gold is currently trading close to its historical all-time high. This is surprising considering the recent increase in real interest rates. Historically, when interest rates rise, it tends to have a negative impact on the price of gold. However, the price of gold remains resilient in the face of these higher rates. Lawrence suggests this may be an early indicator of trouble brewing within the financial markets. He predicts that if the current trajectory continues, we may witness a substantial increase in gold prices, reaching levels as high as $3,000 to $5,000 per ounce. Moreover, over 80% of the $10 trillion rise in global debt in the first half to a record $307 trillion came from developed economies, the Institute of International Finance says. The latest budget shortfall has added to the already ballooning U.S. debt, now at a staggering $33.6 trillion. Lawrence attributes this crisis to the fact that the U.S. federal government spending is spiraling out of control. This excessive spending is particularly problematic because it erodes confidence in U.S. government bonds, traditionally viewed as a safe and stable investment. This uncertainty is pushing bond prices down and driving up interest rates. The Federal Reserve has raised its key interest rate significantly over the past 19 months to tackle rising inflation. Surprisingly, the price of gold remains strong, indicating that the market anticipates a change in Federal Reserve policy. This potential shift might involve additional money printing, which could exacerbate inflationary pressures, making it a cause for concern in the financial markets. Balancing economic growth and stability remains a challenge for policymakers. We will bring you clips from Lawrence Lepard's interview with SOAR Financially. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
We're in a global sovereign debt crisis, driven by the fact that the U.S. federal government spending is out of control, and that therefore people are slowly but surely losing confidence in the U.S. bonds, U.S. federal bonds. And that's reflected in the fact that the price of the 10-year has gone from, threes in the 3 range up to as high as 5.0. It's a little below that right now, but it's quite a big move in a short period of time. And all the shorter bonds have gone up as well. And what this has done is it's driven the U.S. Federal budget into a situation where we're spending almost $1 trillion a year on interest on our $33.5 trillion, or actually $33.6 now, trillion dollars of debt. And a lot of that debt is stacked up in the earlier years. And even with the interest rates where they are now, some of that debt is at older, lower interest rates. So interest costs are going to continue to go up for the federal government unless bonds rally significantly and interest rates drop significantly. Interest rates are going to continue to go up for the federal government, so the deficit's only going to get worse. And this is what we call, and others have called it this as well, a doom loop. The government issues bonds. Those bonds being issued create supply of bonds. There has to be demand. If there's not enough demand, or if there's a fixed amount of demand, all other things being equal, then they have to pay a higher interest rate. So the interest costs go up. They go up for the federal government. That makes the deficit bigger. They've got to issue more bonds. And as you can see, if that cycle continues without being interrupted, eventually there is no bond market. And we're not at that stage yet. But what I think is going on is that's starting to be widely recognized. You're seeing a lot of investors talk about it. You're seeing the Wall Street Journal talking about it. You're seeing mainstream financial pundits talk about it. Those of us in the sound money world have been talking about it for several years now. But I think it's kind of really becoming acute. And the evidence for that is also seen in the price of gold. which historically, when interest rates have gone from 25 basis points, 2 years ago to 525 today on Fed funds, historically that would have really hammered the price of gold. And at some points in time, it kind of did. But right now, the price of gold is in the high 1900s, and it's really just a spitting distance, maybe 5% away from an all-time high, which I think a closing breakout over 2070 would represent an all-time high. And so that should not be happening, all other things being equal. I mean, real interest rates have gone up a lot, yet the price of gold has gone up. And what I think is going on is gold smells what's coming next, which is also outlined in my quarterly letter, which is that the Fed will have to, at some point, change their policy. Because if they continue along on this, as they've been doing, things are going to break and they're going to start to come unwound. And to some extent, things have already started to break. We saw it with Silicon Valley Bank in March, but they had a miniature version of QE where they, broke the Dodd-Frank law and injected money into the banks to keep them going, and they calmed everything down. But it's starting to get critical now, in my opinion, because the 5% rate on the 10-year is a meaningful number. And you're seeing it in a lot of other smaller measures, the U.S.-Japanese yen rate, the 10-year yen cross, and the inflation swaps, et cetera. So that's the big picture macro. And to me, that's the elephant in the room, that the U.S. bond market's in trouble. And people are beginning to doubt, the ability of the Fed to continue what they're doing. And when they shift, they will have to start printing money again. And when that happens, inflation will get worse. And we'll get into a complete cycle of ultimately what will be high inflation, and perhaps even carry to its end point, a failure of the dollar, certainly a failure of the dollar against gold, silver, and Bitcoin. The three things that I consider to be sound financial alternatives.
Gold prices increased on Thursday, buoyed by a weaker U.S. dollar and a fall in Treasury yields after the Federal Reserve held interest rates steady and investors stepped up bets that the central bank may be done with rate hikes. In Lawrence's view, gold possesses a unique ability to see around the corner, implying that it can be a harbinger of impending market conditions or challenges. This metaphor suggests that gold's performance can signal broader economic trends and uncertainties, which makes it a valuable asset, especially during turbulent times. Furthermore, the U.S. central bank has held its key interest rate at its current 22-year high as it seeks to stabilize price rises, which had recently reached near record levels. The Federal Reserve's rate target remains at 5.25% to 5.5%. The bank has been raising borrowing costs with the hope of cooling the economy and slowing inflation, the rate at which prices rise. However, Lawrence disagrees with this consensus view and believes that inflation will likely be much higher than that. Let's get back to the interview.
And as you know, the stocks are high beta plays on the underlying price of the metal. So that, but amazingly, the metal is held up pretty well, and it's held up pretty well because of what we talked about earlier, and that is, I think it can see around the corner, but sadly, I don't think the stocks are seeing around the corner. I think the stocks are, and people are saying, well, this has been a shitty area, and there's still what I call battered gold stock bull syndrome. I mean, it's been really hard for I've been in this since '08. I mean, it's been incredibly hard to be a gold stock investor during this time frame. It's just been really, really hard. Absolutely. And I can't tell you how much investor fatigue there is with me, with my investors, with anybody who's in the gold area. And I was just at Beaver Creek. I was just at the Denver conferences. They were like funerals. I mean, there were people there, but it was all the hardcore gold people. There were no new faces. And frankly, most of what was going on out there, in my view, was the smart big companies were there to meet the cheap small companies that were running out of money so that they could figure out what they were going to buy, because they can actually buy. I mean, there are multiple instances of smaller companies where 20, 40, 50, $70 million have been invested to drill a resource and plan a mine, and they're selling for a third of that in terms of the market cap. So, if you're a big company, if you're a big mining company and you have capital, you have access to capital, you're much smarter to buy than to build. If you try to, if you go out to build, you're going to have to pay full retail. But if you buy one of these companies, you're buying a lot of somebody else's work at a discount. So, and I think that takeover wave is coming. But what really needs to get all this going, because that's what people probably care about, is we got to get through this 2100, 2070, 2100 level, right? I mean, we touched 2019 way back in 2011. We've now bumped up against the 2050, 2070 level 3 times. There's a nice line drawn there. And as you know, with algos and the way the world works, you know, we need a breakout. We need to go to 2100, 2200, and then we'll squirt up to 3000 quickly, come back and retest, and we'll be off to the races again. And I think that will happen when people start to get the joke that the Fed really can't do what they say they're going to do. The Fed has convinced the world, and I know this because if you go to Bloomberg and you look at the 5x5 swaps, 5x5 inflation swaps, which is a measure of what inflation will be in 5 years for the following 5 years. So you can bet, you know, will it be higher than this number or lower than this number? Well, right now, quote unquote, that number is 2.65%. So people, you know, investors in the world are betting that in 5 years, inflation will be 2.65%. My view is no way, bullshit. Inflation is going to be much higher. And so, you know, the way that I invest, or the way that I think successful investors, you know, make money in the market is you find the divergent view. You find the consensus view that you believe is wrong based on your logic, and you bet against it. And so, you know, what I think is going to happen is, you know, eventually what I've described, the monetary debasement issue, and the federal debt doom loop issue, are going to force more and more people.
Gold prices have risen due to a weaker dollar and stable interest rates by the Federal Reserve. In the near future, gold is expected to remain strong and possibly increase further, driven by factors like rising global debt and potential changes in Federal Reserve policy. What are your thoughts on the future price movements of gold? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.